how to invest in the stock market for beginners. So you've probably heard of the stock market before, and maybe you want to invest. But where do you begin? How do you start? What do the numbers mean? We're going to cover a lot of the basics today that everybody needs to know before they begin investing in the stock market. Evaluating stocks and looking at what the numbers actually mean. Warren Buffett, one of the most famous investors, has famously said, if you don't learn how to make money while you sleep, you will work until you die. This is one of the keys of building wealth. So let's jump in. All right, so we're here in my office. I apologize for the echo-ness. It's There's not really anything to cover the sound. So anyway, I'm going to jump right into explaining some of the basics on stocks. So before you can really buy or trade any stock, you do need a brokerage account. It's a little different than a bank account, and I would encourage you to do an online brokerage account. This will allow you to have the smallest amount of fees and also the most opportunity to trade easily with their platforms and apps. There's plenty of brokerages out there that are really good. Charles Schwab, TD Ameritrade, Merrill Lynch, I can go on and on. Most of them are very compatible and similar with most devices and most trading strategies. So I would just do a Google search of best brokerage account this year, and you can sign up for one there. It's very easy. But that would be your first step if you want to start trading. Don't go to your local bank. Your local bank will probably charge you more in fees and have probably a worse platform to use to trade. So now, though, we're on step 2. So assuming you do have a brokerage account set up, we're going to jump right into how to evaluate stocks. So here, as you can probably see, I've got Apple pulled up here in Yahoo Finance. You can find all of this information on a lot of different platforms. Your brokerage account will have ways you can search stocks and look at their information. I prefer using Thinkorswim. It's an application that's free, and we'll do a video on that another day, but I just want to cover some of the basics, the fundamentals. So I'm going to skip over previous close, the open, the bid, and the ask. I think those are pretty self-explanatory. The bid is what people are willing to pay, and then the ask is what people are willing to sell, right? That's kind of, right now the market's closed, so these are the last bids and the last asks. But let's jump into the day range, right? The day range is pretty self-explanatory, but it's the range of prices that the stock was sold at within that day. So this tells you the immediate range, and it could tell you of a trend up or down for that day. It doesn't necessarily always mean that there's a trend up or down, but it could. The 52-week range is also pretty self-explanatory. This is the range within the year. So it tells you what the lowest price was for the stock and the highest price is for the stock. And it's moving because it's always the last 52 weeks. Now this helps you to see if there's a stock that's potentially oversold or overbought on a longer time scale. It also can help you see a trend on a larger timeline. So if something is trading up toward the top end, it could be pushing up and on an uptrend because it's making higher highs. If it's low or it's going below what the 52-week range is, it could be making lower lows. It's on a long-term downtrend. The third thing that we're going to look at here is the volume and the average volume. Now this I'm kind of lumping into one, and it's pretty self-explanatory, but the volume is the amount of stocks traded within that day. And then the average volume is just what the normal day looks like for that stock. Now, this helps you to see the movement of a stock or the liquidity of a stock. If the volatility or the volume is very low, you may have to wait a little while before you can buy or sell the stock. Sometimes there's longer periods if there's not a lot of people buying and selling. And this is where penny stocks or some stocks with very low volume can be very dangerous. because while you're waiting to buy or sell the stock, it can move quite a bit in the wrong direction and you could potentially lose a lot of money. This is often a way people scam people in penny stocks. They do what's called a pump and dump. And because there's this lag in the time of the orders being able to get filled or not, they can basically manipulate the price. So volume is pretty important, that it has at least a decent amount of volume. The next thing we're going to look at is the market cap. And this is pretty self-explanatory as well, but this is the value of the company based primarily on how many stocks are available, both owned and outstanding stocks, and then the price of the stock. So this will help you know the size of the company, which often will imply credibility and an amount of safety. Now, it's not a surefire thing, but generally the bigger the company, the less likely it will go bankrupt quickly, right? This next one is an interesting one, and it plays more of an important role in certain strategies of investing, but it's called the beta. Now, the beta is a Greek character that is used to measure the volatility of a given security or a stock. So without getting into too much detail, it measures the volatility. The average, the base volatility for the whole market is 1. So if the beta is over 1.0, it means it's generally a little more volatile than the average. If it's less than 1, it means that it's generally a little less volatile than the average. Now, just a side note, slightly higher volatility doesn't necessarily mean a bad thing, because remember, volatility is measured to the upside as well. So here, for example, Apple stock is a pretty steady stock. Year to date, it's doing okay. The past year, it's done really well. But you'll see that the beta is 1.28 right now. That sounds, if you're just thinking of volatility, that sounds like it could be kind of dangerous. But a lot of Apple's volatility is to the upside. And so that's why it can be a little over 1 and not necessarily be a bad thing. Now, this next piece, I would say, is probably one of the most important when evaluating a stock. It also just has the most information in a single unit of information, a single data point, the PE ratio. And you'll hear stock traders especially talk about PE ratios often. It is basically just the price to earnings ratio. So it's the price of the stock over the earnings predicted for that given share. So it's price per share over the earnings per share. Now, what's great about this is it can help you know if the company makes money. Now, that's important. There's a lot of investors who only want to invest in companies who are actually making money. So you can make sure you're protecting your money from companies that are just overhyped, right? The other thing this allows you to do is to see very quickly if the stock is overvalued or undervalued compared to the market as a whole or compared to its competitors. So for Apple, I can quickly search Microsoft or some of these other tech companies that are competitors to Apple and look at their PE ratio and see if it's above or below. Now, it's not the only thing you take into consideration when you're buying a stock, but it does help knowing where it's at within the market and within its competitors. The important feature of this, though, is to know that the PE ratio is not a set number like the beta. It adjusts with the market. So the market as a whole has a PE ratio, and it moves with the market as things get inflated or earnings are high or low. That average PE ratio can change. The next one is a very important one as well. EPS is earnings per share. Now, this is a quick way to realize if the company is making money and how much, and that helps you to analyze how much cash flow these companies can be bringing in per stock. The next one is the earnings date. Now, the earnings date is the week that this company will be reporting on its earnings from the previous quarter. So this is a helpful time period to note to see if there's going to be good news or bad news, or just know that there might be extra volatility in this week as earnings come out. And often, even the week before earnings, you'll start noticing the stock acting in an unusual way because people are expecting things to go good or bad. The next one is the forward dividend and yield. This is also often just referred to as the dividend. If you're looking on different platforms, sometimes it might just say dividend. But the dividend is simply the payment the company will make to its shareholders on an annual basis. So this is additional money that is made beside the stock's growth. So you see here, Apple over the past 6 months has grown in the value of the stock, but also annually they pay out $3.08. And right now, with the current value of the stock, it's about 0.95%. Now, this dividend, depending on the stock, can be paid out monthly, it can be paid out quarterly, or it can be paid out annually. And each stock will be a little different. I believe, I might be wrong, but I think Apple's is annually, if I'm not mistaken. But the dividend amount, the $3.08, will always be the representative number for the year. Next, the ex-dividend date. This is important if your investing strategy has dividends as an important feature. This is this is the cutoff, I should say, for the dividend payment for that quarter. So if you want to be able to qualify for the dividend payment for this first quarter, you would have had to have bought the stock before February 6th. So if you bought it February 5th, you would be paid that quarterly dividend if it's quarterly. And then last, the 1-year target estimate. This I would say is not very important if you're doing your own stock analysis or your own analysis on this kind of data, because this is based on analysts. They're kind of suggesting or assuming it'll probably be at this price within a year. But these are some of the just very basics of understanding how to evaluate a stock. You definitely don't need all this information, and different strategies rely on one or a couple of these more than others. So I hope this helps you guys understand a little bit more of the basics of evaluating a stock. If you found this video helpful, please don't forget to like or subscribe. And in our next video, we'll go into the details of how to actually buy your first stock, ETF, or mutual fund. So we'll see you next time on Millennial Money Investing. This is Brady. I hope you have a good day.